You're going to learn how to fund commercial real estate, how to raise money from family and friends, the truth about the upcoming recession, and how to build key banking relationships that could be amazing for your business on this episode of Exactly How.
You're listening to the Exactly How podcast, where you'll hear the underground, closely guarded wealth building secrets of successful people around the globe. Discover exactly how to improve your mental, physical, and financial health. Feel better, make more money, live, give, and prosper in today's exciting, fast-paced world filled with opportunity for those who know exactly how.
Hello, everyone. Welcome to the Connected Investors Podcast, Exactly How. During this episode, you're going to discover exactly how to raise capital for commercial real estate. For those of you who are new, my name is Ross Hamilton, today's host and CEO of ConnectedInvestors.com and PrivateLenders.com. Today, we have the privilege to learn from a guy who's an expert really in all facets of CRE, including acquisitions, finance, management, and capital raising, deal structuring, and even advisory services. Prior to his career as a real estate investor, he was a senior accountant, controller, AVP, SVP, president, managing partner, and executive managing director. But all that changed when he got recruited to go to work as a controller for a commercial real estate syndication firm in Chicago, and he just loved the business so much he went all in. I would describe our guest as, a very highly accomplished commercial real estate executive with significant knowledge and expertise in acquisitions, finance, REITs, capital markets, development, raising capital, securitization, and asset management. His name is Joseph, and today he's going to explain exactly how to raise capital for commercial real estate investments. Joseph, thank you so very much for jumping on the line with me and all my members.
Thanks, Ross, and it's a pleasure to be here.
Yeah. Before we dive in on exactly how to raise capital for commercial real estate, Joseph, you said you contribute a lot of your success to reading. Why do you think that has played such a big role in your success?
Well, you have to always accumulate knowledge. Learning never stops, and I've always been a big reader. I'm also a big fan of Warren Buffett, and Warren Buffett spends 4 or 5 hours a day just reading reports, financial statements, 10Ks, 10Qs. I also am an adjunct professor of finance at Santa Clara University, and when my students ask me, Professor, how can I get better, make myself smarter? I say one word, got 4 letters: read. And reading is important. Absolutely.
Yeah, it works, especially in the real estate world. Once you stop learning, you stop earning.
Exactly.
A lot of people think once they get out of college, they're done.
Yeah.
But that's really when it starts. So yeah, definitely. Thanks for sharing. And I'm glad you have a teaching background, because we have a very exciting and, seemingly complicated topic to cover today, but I know you're going to be able to break it down so a lot of our newer real estate investors or aspiring real estate investors will be able to digest everything we're covering here. So what makes the Exactly How Financial Freedom podcast very unique is each show comes with a detailed action plan. So we're going to pull all of the knowledge out of Joseph's head, and you'll be able to go right to exactlyhow.com and you'll be able to read the notes. So if you're driving right now, you don't have to worry about writing notes down. So we have that all covered for you. In addition, when you visit exactlyhow.com, you can throw your name in the hat to win our $3,000 Pre-MLS software, which shows you all of the best residential and commercial real estate investments before they hit the MLS, before they go up for auction, all of the most motivated sellers around the entire country. A $3,000 value. We're going to give it away to someone, a lucky listener, today for free. So if you're listening to this live on Facebook or YouTube, definitely visit exactlyhow.com right now. Throw your name into the hat. Maybe you'll be the winner. So, Joseph, before we jump in and we start talking about financing commercial real estate investments, there's a lot of interesting language that we're going to be using throughout this, and I just want to kind of define that going into the first section of this episode. You talk a lot about a sponsor. What is a commercial sponsor? Because that's not really a term used very often in residential real estate.
Well, the sponsor typically refers to the company or the entity that is buying the property or raising the capital. And they would be the general partner, because most real estate deals are in limited partnerships and LLCs. So you can use the sponsor, the general partner, the owner. Those are all synonymous terms in real estate.
Okay, great, great. I just wanted to cover that as we start to kind of dive into breaking down exactly how to finance commercial real estate. And can you explain a little bit why financing commercial real estate is different than financing maybe a residential fix and flip?
Yes. Well, remember, single family homes are very homogeneous, right? And the financing process is very efficient. You got Fannie Mae, Freddie Mac, they probably buy 70 or 80% of the mortgages today. Commercial real estate is all heterogeneous. Everyone is different. So the financing is going to be different. Depends on the type of leases, the cash flow, the NOI, the age of the property, does it need renovation, and so on. You could have two of the exact same physical buildings on a corner, and they could be valued totally differently depending on the leases, the rents, the management, and so on. So every real estate deal is different. That's what's fun about the industry, and that's what makes it a little more difficult to get debt capital and equity capital. But in today's environment, this is the best I've seen in my career.
You hear that, guys? This is the best he's seen in his career, and you've been doing this for a little while. When did you start investing in commercial real
I've
estate?
got into commercial real estate in 1981. And as I said before, I'm dating myself. The last 6 years, Ross, after the financial crash, more money has been made in the last 6 years in commercial real estate than in the prior 20 combined. This is booming period. We've got low inflation, we've got low interest rates, ultra low interest rates, and great job growth. And those are the two most important metrics for commercial real estate. Low interest rates, high job growth, and we have them both, and we have a booming economy.
Yeah, fantastic. And for those of you who listen to a lot of the Exactly How podcasts, we've done a few podcasts where we show you how to locate different commercial real estate investments, but we've never really dove deep into the financing. We've kind of just touched on that lightly. So we're going to go deep right here on exactly how to structure the financing. And you can go ahead and browse our previous podcasts and YouTube shows at exactlyhow.com, or you can visit the Connected Investors YouTube channel. So Joseph, before we started, we broke down getting financed into three main steps: lining up the debt, lining up the equity, and then closing on it. Since we're not going to go too deep into identifying the property, is there anything that you want to say about identifying a property before we go into those three steps?
Well, the best thing is to have some circle of competence in the deals you're looking at, commercial real estate. If you know apartments, then buy apartments. If you're an apartment investor, developer, and you're successful, a mistake I see a lot of times, that person goes out or that company goes out and they want to buy a hotel. Hotel's totally different business. It's an operating business more than a real estate deal. So stay within your circle of competence. And if you're small, stay within your area, a couple mile drive. Okay. When you get bigger and bigger, then you can expand regionally and even nationally, and then start raising capital in a fund type structure and so on. But stay within your circle of competence. Make sure your management process is good, because a lot of the value in commercial real estate is when you buy it, and also how you manage it, how you create that value.
Yeah, exactly. When you go to resell your commercial real estate, which we're not necessarily going to talk about here in much detail, having all of your T's crossed and I's dotted, good lease, good financials. They're buying a business. When you're buying a commercial piece of property, you're buying a business. So you want to make sure to have a good history to show what's going on.
Yes, exactly. Management is very important, and leasing.
Yeah, management, leasing, documenting, being able to show the history of that property over a long period of time is really important. So your background in accounting probably has played a bit of a role in your success.
Yes, definitely. I'm a CPA by trade. I'm also a CFA. I also have an MBA. But yes, the training I got in accounting has been invaluable to get through all the numbers and make sure I can understand something.
Yeah, the very first person I hired when I was ready to grow and scale my company was someone with your skill sets. Because at a certain level, you either have them or you don't. You can get a little better by reading about it. But it sounds like you really love to roll up your sleeves and dive into the numbers. And that was, that's Warren Buffett's thing. That was Rockefeller's thing as well. So when the numbers can start, speaking to you, that's when you can follow to the profits. Well, let's go ahead and break down section number 1. You found a property. It's in your wheelhouse. You're excited about it. You brought it to a few people that look over it. They said, yeah, this is a great deal. Now you have to line up some debt. So let's specifically talk about the debt aspect of a commercial real estate deal.
Okay, typically the debt's going to come from a local bank, okay, local savings and loan if it's apartments. There's some other avenues, but those are the two main ones. And to get debt, a lot of times, probably 80% of all commercial real estate deals, the debt will come through a mortgage broker. Typical fee to pay a mortgage broker is 1% of the amount of the debt. And the owner and the broker will typically have to put together what's called a loan package. Could be 10 pages, could be 20 or 30 pages, no longer than that. And this package will outline the transaction, and you're going to send that package to 6, maybe 10 lenders through the broker. The lenders will look at it. If they like it, they'll call the broker up, ask some questions, and if they really like the deal, they'll send what's called a term sheet. So usually a non-binding one-page letter. Continental Bank, we like your deal. Here's the general terms and conditions upon which we will, fund your project. Here's the loan amount, here's the interest rate, guarantees if there's any, and so on. And once that process starts, the lender will, if you accept a term sheet, and again, it's not binding, will come out to see your property, meet you, take a tour of the property, look at the market, and so on. If everything's copacetic from there, you will go to an actual loan application where you have to put up some money. The loan application will be 15 to 20 pages. And from there, you will go to close your loan, document your loan transaction.
Okay, great. So local banks, I've heard that time and time again on the commercial side. Getting the debt from local banks always seems to be the best resource.
Yes, because they're in the market. It's the easiest. They're going to be the cheapest. But, you can probably talk to 10 banks and, 7 of them are going to say no for whatever reason. 3 of them are going to say yes. It's really a numbers game. And out of the 3, you're going to pick one. The big risk for the borrower, is that typically the VP at the bank who's, working on your deal, oh, this is great. Joe, we like this deal, but it has to go to loan committee. And I've seen a lot of deals where the VP, I ask them, hey, is this thing going to get approved? Oh, yeah, no problem, Joe. Don't worry about it. And 2 weeks later, I get a phone call, hey, the loan committee, decline your deal. So that happens a lot. That's why you got to have 2 or 3 banks, in the queue in case that happens. So if you're not that sophisticated, you have to understand that can happen. And for any reason, they can do that. It's you don't know, you don't care. You have to go on to the next lender.
Yeah. So when you're submitting this package, is the broker helps you put that together, but can you explain to me what some of the documents are in this package that you're submitting?
Yeah, this loan package is going to have an executive summary. It's going to have what your loan request is, how much you're requesting, what rate, guarantees, amortization, fees, etc. It's going to have some financial data on the property. It's going to have a rent roll in there. It's going to have maps, demographic data, and then the bios on who the borrower or sponsor or general partner is, and then what the entity is. That's typical information on any loan package.
So the bios, if someone is completely new and has never done a deal before, and the bank looks at this bio and they're like, all right, this guy used to be a teacher. Now he has this great deal and he wants us to fund it. How important are those bios? And can you kind of stack the deck to bring on some partners that might have some experience if you don't?
Exactly. If you don't and you are that teacher, if it was just you, it's going to be a little more difficult, but you should bring, and you want to bring in because you don't have the experience of buying and running, managing, leasing commercial real estate. So you should bring on some partners or advisors. You can create an advisory group within your company, put them in the package as, either employees or advisors or on your board or something like that. And that'll help you get around that issue of not having the required experience.
Yeah. I mean, everyone starts from somewhere, but it's, you definitely want to bring on those advisors because there's a lot of sharp pivots that can happen in some of these deals.
Yes, definitely.
Great. So what about being proactive ahead of time? Someone's like, I'm going to do this. Do you start making relationships with banks ahead of time? Or is that just, if you don't have a deal, there's no reason to talk?
It's always good to have banking relationships. And, if you get invited to a party or a real estate seminar or something, yeah, definitely make those relationships. And who knows? I always want to have good relationship with bankers, because you never know where you're going to have to go to them for, a loan or some transaction, or even your cash business, your cash checking account, payroll account business within your company.
Yeah, it's always nice when you can send a text to the VP.
Yeah,
Say,
exactly.
this is the deal. Yeah, come in tomorrow. We'll help you out. Well, great. I think that was a good breakdown on the debt side. What about personal credit? This is a commercial deal. How much does your personal credit play a role?
It depends on the banks. A lot of smaller banks, even though they have the collateral of the property, they have a mortgage on the property, they may want your personal credit. That's just how they operate. Not all of them. I would say probably 50-50. If you look at 10 banks, that's just a decision you'll have to make if you want to get the loan. And a lot of the smaller banks, that's just how they operate.
Mm-hmm. Okay. So someone with bad credit is definitely going to need a partner.
Definitely. And they're not only going to look, it's not so much a FICO score, it's going to be what your financial statements look like, what's your net worth, how liquid are you? And they're going to ask for your financials. Okay, they don't have to be audited, just reviewed, or you can put them together, but they want to see what your net worth is. So if you're trying to buy a $5 million apartment complex and your net worth is $50,000, you have no partners, that's going to be tough to do. Okay, yeah. Not impossible, but tough.
Okay, so it's definitely not impossible. So what would tip the scales in your favor if it was just a slam dunk deal?
Slam dunk deal would help, and you have the equity investment all in advance, ready to go, and you don't need high leverage. So instead of getting a 70% loan of the purchase price, maybe you come down to 60%. You have 40% in equity. That makes the lender a lot more comfortable. You have some big equity investors. Maybe they're prominent, players around town. They're in the deal. The bank, there's a higher likelihood the bank will approve your deal.
Yeah, you said a lot of key things there. What I'm hearing really, guys, is you can network your way into this. You can relationship your way into this if you don't have money, if you don't have the credit. We're going to talk about the equity side of it. And what that really means is how much money are you bringing to the table?
Yeah.
And the difference between a commercial piece of commercial real estate and residential real estate is usually the investor is taking the money out of his pocket to put toward the down payment. But in this case, we're going to break down the equity side, and there's a lot of syndication there. So let's, I think we covered the equity, the debt pretty well. Let's go ahead and talk about step number 2, the equity. Break it down for us, Joseph.
Sure. And where do you get the equity? I always get this question. And there's 4 areas. The first place you go is friends, families, attorneys, and accountants, and even put your insurance guy in there. Those are the first people you always go to. If you can keep it local in the house, people who know your family, relatives, your attorney might have some contacts, even your banker might have some contacts, your accountant definitely have some contacts. That's the first place to go. If you can't get the capital there, then you have to go to higher net worth individuals. Maybe you'll meet them through a broker or through some organizations in your local town or city. The third way, if it's bigger deals, you have to go through the independent broker-dealer network. These are for larger transactions, more institutional size. And when you get real big, then you're going to try to structure a fund where you're trying to raise, tens of millions or hundreds of millions or even billions of dollars of capital. So those are the 4 equity targets, depending on the size of your deal, your experience, and so on.
Let's talk about the first 2 and how to structure those.
The friends and family, what you have to do, just like you had to prepare a little loan package for the debt, you have to put together a little package. The legal name, it's called a private placement memorandum, or PPM. You don't have to have something that's 200 pages at this stage, but you have to put something together to comply with private placement rules. It could be 10, 20 pages long, same type of sections. Here's an executive summary. Here's the equity we're looking for. Here's the preferred return we're going to pay you. Here's how much of the property you're going to own. Here's information on the property, financial data. Here's our background. Here's our strategy and objective with the property, and so on. And that'll go out to your potential equity investors, and it gives them something to look at and say, hey, you know what? We like this deal. We like Joe, and we're going to invest in his property.
Yeah. Well, let me ask you a question here. Maybe put you on the spot a little bit. Do you have a sample version of one of those that you might be able to provide us that we can give the members?
Yes, I can provide a sample, definitely.
Yeah, that would be great. So we'll make sure to have that on exactlyhow.com so you can kind of see what he's talking about here. And this is what you would take and you would bring to your friends and family.
Exactly.
Gotcha. And that's probably where most of our individuals are gonna start. But it just goes to show everyone that you should always be networking within the real estate community, within the finance community, because the equity side, we didn't really talk about timelines, but Joseph, we should jump into that, could take a long time unless you have you made these connections already and people are ready, willing, and able to say, hey, Ross, when you have a deal, let me know. So the debt side, before we jumped onto the podcast here, you said is typically easy to get done in a short period of time because most deals you have about a 60-day window to get done?
Yes.
So you get the deal.
And that's especially today where there's so much capital floating around. And in general, debt is always easier and it's always cheaper, obviously, than equity. And even equity today is not hard, but you still have to go through the various hoops to get it.
Gotcha. So talk me through how long it could take a first-time person to raise the equity.
Let's say you're doing that $1 million deal and you need $300,000, 30% is the equity. And in your equity book or your memorandum, you might say, hey, I'm looking to raise 300,000 in units. Usually it's in unit sizes of 50,000 a unit. Okay. So, you need to raise 6 units. Well, if you have some prior relationships and go out to people and say, hey, today a lot of people are doing very well. They have a lot of money, a lot of investments. That might not be that difficult to find 6 people to put in $50,000 into your property. Maybe you find 3 people to put in 100,000, and that's where you go. And that could typically take, a couple weeks, could take, a month, could take, more than a month. But in today's environment, if you hustle and, with some luck, you can get it done within that 60 days.
Gotcha. Definitely be proactive though, and be making those relationships, ahead of time. There was, PPMs come to me all the time, and I had someone I know, like, and trust. They sent me one. And I said, yeah, let's do this. And then, the last minute the deal fell through. Right?
Yeah, that happens a lot. And that may happen to you. And so you're going back to those investors for the 3rd or 4th time. And, they may have declined the prior 3 deals. The 4th one, boy, we like this one, Joe. Count us in, circle us in for the money.
Yeah, exactly. And then you got to get them to actually send you the money.
Yes.
I've been that guy before that has said, yes, sounds good. And then they have to chase me down to get the money. And I'm like, yeah, I'll do it tomorrow when I'm driving over here by the bank. I'll send the wire. And so you got to be thorough with people, follow up quickly, and give them some timelines. Yes.
And then there's some legal documents they'll have to sign. You get those over there right away with your attorney or whatever. But yes, that could be an issue. Typically it's not, but it could be.
Yeah. Just herding the cats, getting the deal done. Great. So we talked a little bit. Anything else we need to talk about as far as equity goes in the friends and family type round?
Well, you in general, you have to know what you're going to offer these investors. Okay.
What's typical? What's
typical structure today? And this varies, but you as the owner sponsor are going to end up somewhere around 20-25% of the ownership. The investors are going to get 75-80% of the ownership. Okay. And if it's your first deal, my first deal, I offered, it was 80-20. They got the big piece. And then we, in commercial real estate, there's also something called a preferred return. And most general partners or sponsors will offer their equity investors a preferred return before any other capital is paid out. The investors will get a preferred return. That preferred return today is somewhere between 5 and 10%. My first deal, I offered 10%. That was way above the market, but I wanted to make sure I got the equity raise. I didn't care. It took money out of my pocket, during the holding period of the property. So what's the split, ownership split? What's the preferred return? How do you allocate the capital upon, refinancing, sale, and so on? And then, you know, is there going to be a management fee, property management fee, asset management fee, any other fees going to you as the general partner or sponsor? And all those will be disclosed in your little memorandum.
All right. So let's say you work out a deal. It's you wind up owning 25% of the property. Investors owe 75%. Tell me about these other fees that as the sponsor that you can include to kind of sweeten the pot for you a little bit.
Yeah, some sponsors will take an acquisition fee, you know, maybe 1 or 2% of the purchase price. Some might take an organization fee for putting the deal together. Typically, those fees today are not more than 3 or 4% of the purchase price of the property. 20 years ago, they were 10%, even 15%. Those days are kind of over. Those are really heavily feed deals, they call it. And those fees are called the load. If you want the technical term, that's the load on the deal. So, and some sponsors won't take any fees up front. They get reimbursed for all their costs, legal costs, marketing costs, travel, and so on. But some will take some small fees up front. The operating fees, they will get a management fee for managing the property. They do it themselves. And some will take an asset management fee if there's multiple properties in a portfolio, but we could talk about that, you know, later on. Yeah.
Well, you know, I'm thinking if I'm a sponsor, I went to the bank and I got the debt, and you just told me that I'm going to have to sign on that debt.
Yes.
For most local banks. So I have that risk. I didn't have to take any money out of my pocket because I was able to syndicate the deal. But now I also have all the time of babysitting that deal. So that's kind of where some of those fees, I think, are fair for someone who has to make sure that happens, that the deal goes all the way through to the closing table and then gets resold.
Yes, and as long as they're reasonable in terms of percentage, yes. And even today, Ross, a lot of sponsors have to put some capital in. That was also not an issue 25 years ago, 20 years ago. The sponsor never put his own capital in. Today, you know, a lot of the investors are going to say, yeah, Joe, we like the deal. We want to make sure our ships are all sailing together. It's like in The Godfather 3.
Yeah.
Okay? So we're going to put all the equity in. We want you to put a piece of it in too. You know, 5%, something like that. It's not a big piece, but they want you with some commitment to the project other than being the sponsor of it.
You know, even if you take on all of the credit risk with the debt, they'd still want you to throw some money in.
Yes, typically.
Now, guys, if you're dealing with friends and family that are kind of new to this, right? They might not have the same insight to require something like that.
Yes, exactly. True.
So, you know, it all depends on, you know, who you're talking to. $1 million deal raising 300,000 is not much, but once you start kind of going up the food chain, deal gets bigger. So you might have to throw some money in.
Yes, and as the deals get bigger, your investors are more sophisticated. Mm-hmm. So they've been in a number of deals before. They've seen the good, the bad, the ugly. You know, they're going to require you to put some money at risk.
Yeah, absolutely. All right. Well, before we jump into the next step of closing, which is the most important, we have to announce the winner of the Pre-MLS software. This individual went to exactlyhow.com, threw their name into the hat. They commented on a few of our videos. They gave us a thumbs up. They shared the information that they're learning right here, and we really thrive off your interaction. And the winner of today's show, actually, ironically enough, Joe Senelia. Joe, congratulations. We'll get you all set up with access. You can log in and you can search for properties and start making those investments right now in this hot market. And if you find some commercial deals, you can re-listen to this episode and learn how to syndicate them. You also wrote a book, didn't you?
2 books, actually.
2 books. Just give us, the elevator pitch on these books. Do you have one nearby? You going to show it to us?
Yes, I've got them both here. I'll put them both up.
There you go.
See them?
Yep. Perfect.
The first one is called The 50 Commandments of Commercial Real Estate Investments. I wrote that in 2015. It's just based on my experience. I wanted to, put something in writing. I never wrote a book before. Very hard, actually. Even though I do a lot of writing, I have a monthly newsletter and so on. But it's been very popular. A lot of the big brokerage firms bought it, and they required all their brokers to read it and so on. So yeah, it's been very successful. Self-published on Amazon. Unless you're Sam Zell, it's hard to get a real estate book, commercial real estate book published by a publisher, or Donald Trump, obviously. The second one was commercial real estate investment for pros and dummies too. That was,
You hold it up again?
yeah, it's, I
Okay,
wanted to do a takeoff on all those dummies books.
yeah, pick it up a little higher. There we go. Okay, great. We'll make sure to have the links to these books on
Yeah,
your
on
exactly.
Amazon. So I wrote that last year, Ross. It came out in March of 2018, and it's also done very well.
Awesome. You know, you said how hard it is to get a book published, and we've been talking about connections. I sent a book in to get published, ironically about financing real estate on the residential side, and the publisher who looked at it, I had some advisors. He went to he was in a fraternity with one of the advisors that was on my board. Who actually happened to be the CEO of Lending Tree. So basically, my book made it to the top, and they actually published me and made it in Barnes and Noble. But it was because of the connection.
Yeah,
Right?
and that's a more broader topic too for the everyday individual. Once you get into commercial real estate, the market shrinks a lot, and the publishers, unless you have, like I say, a big name, it's very tough.
Yeah, no, you're right about that. But it's all about it's also all about who you know, whether you're writing books, whether you're trying to get a loan pushed through. Going out, networking, shaking hands, being a good person, caring about people, following up, providing value without expecting things in return, are some of the topics that we talk about on the show. And, it's those things that it's hard to quantify the value of those things. But when you look at someone who has it easy and they can get deals done and they always seem to know someone, they're doing something special there. So.
Yeah, so you're exactly right. That networking is key. You have to meet people. I used to measure my success in commercial real estate by how many business cards I had. And I used to have them that would be the length of my arm. And now today, you don't give out cards that much. It's all email and electronic. But yes, you have to be out there. You have to go to seminars. You have to go to lunches. This morning, I was at a real estate. I gave a little presentation at a real estate breakfast. I speak a lot. You have to do all those things. And you will, and success will come, not only in commercial real estate, any business or industry.
Yeah. There's a little book I read a while back about never eating alone. Just making sure you have a lunch meeting every day.
Yeah,
and
exactly.
Sometimes you get in those rhythms and you just get stuck, and then you go to an event and you get re-energized. You're like, it's so good to not be in my own head for a little while. So. Well, great. Let's go ahead and talk about the final step, closing. So you got the equity lined up, you got the debt lined up.
Yeah, and from there, it's you're on the home stretch. You've got to, your lender is going to have a bunch of closing requirements in the loan. Your seller is going to have a bunch of closing. They're called precedents to closing. Once you meet all those, and these are mostly property related or legal related, hopefully your attorney's on top of everything. And remember, there's third parties involved in these commercial real estate closings. You need an appraiser, you need an engineer, you need an environmental report, title company, insurance. So all those third party players have to be able to deliver what they're supposed to deliver by closing. And today, since the industry is so booming, it might take you 3 weeks to get an appraisal today. So, you have to make sure you have all those third-party professionals that you're working with lined up, and they're coordinated with your seller and your lender.
Yeah, no, it's crazy. There's always something that holds up a deal. When the market's good, everyone's busy. When the market's bad, it's hard to line up the funding. So
exactly.
Being thorough and having those checklists are key to getting it over the finish line. Anything else you want to talk about as far as debt equity or the closing, or common mistakes you see, or just anything else that could really help our listeners push through?
Yes, if you're going to buy property, commercial real estate, now's the time to do it. You're right. When times are great and capital is easy, the problem is prices are high. When times are bad and capital is tight, prices are low. That's when you really want to buy. And it usually in those times, nobody has the money, or you can't get the capital. But today is a great time. The economy is booming. Don't pay attention to this recession talk. It doesn't make any sense. There's no way we're going to have a recession when the unemployment rate's 3.7%, and we're at a 50-year low in weekly jobless claims that are averaging about 208,000. So We have an election next year. Nothing's going to happen then. After that, we may go into a normal recession, but everything's looking good now. Now's the time to get out, get your deal done, get your next one done. Don't be afraid. You may get turned down a lot. That's normal part of business, whether you're in sales, real estate, anything, and if something goes sideways, if you do a deal and it goes sideways, or you have to file bankruptcy or something, get up, dust yourself off, go after the next one. Don't be afraid. Every successful investor has failed numerous times before they became a success.
Yeah, that's a really good point there. And so in your network, you probably know a lot of people who have been through, been through the ringer before, and now they're probably better than they ever were.
Oh, Ross, I'm one of them. I was in the crash before this crash of 87 and 92 in Texas. I mean, I bought my first condo for $82,000 in 1984. 3 years later, it was worth $39,000.
Yeah.
So yeah, I've been there.
That's quite a haircut.
That's how you learn. It's expensive, but that's how you learn.
Yeah, exactly. And for those of you on the podcast here and YouTube show that have been following me for a while, my background was actually in BMX. And if you weren't falling, you weren't learning anything.
Yeah.
If I came home and I wasn't limping, I was just just kind of going through the motions. So you gotta get out there. You gotta put yourself in those situations where there are some unknowns, and that's where all the interesting things happen in life.
Yeah, and now with this roaring economy, I'm out in the Bay Area. You're on the East Coast. Everything here is on fire. You can just tell by the traffic. It takes 2 hours to get anywhere in the Bay Area today. So now's the time to get out there, build up your portfolio. I know a lot of people who were in different industries, and today they're just small local real estate investors, but they have a net worth of $5 million.
Yeah, absolutely. Well, great. Let me ask you an important question here. What do you think your life would be like if you never found real estate?
Well, I'd probably be in corporate America land somewhere, CFO, probably CEO by now, but I'd be in some corporate business, could be, oil and gas, technology, who knows? When I started out in accounting, my clients were all manufacturing clients, and I was a very good LIFO guy back then. That's inventory method. And then I got recruited, as I said, to go to work for VMS Realty. I didn't know anything about real estate. And then I got into business, and I was controller for 2 years, Ross. And then I saw all the action was in the acquisition side. And one of the VPs of acquisition, a guy named Bruce, liked me, said, hey, why don't you come over to the acquisition side? I went over as AVP, and he taught me the acquisition business. And it was the best time I ever had. And the learning was just tremendous.
Yeah. Well, great. Do you have time to go over the rapid fire section of the show here?
Sure.
I'm just going to ask you a few questions, and just the first thing that kind of comes to your mind.
Okay.
So on a scale of 1 to 10, how strict were your parents?
7.
Get up early or stay up late?
4 o'clock in the morning. At the health club, 4:30.
There you go. How many hours of sleep do you get?
I need 8. I usually get 6.
Favorite or most recent book you read other than your own?
Anti-Fragile by Nassim Taleb.
If you could be any superhero, who would it be?
Superman.
Someone said Warren Buffett the other day, and it cracked me up.
Yeah.
Something everyone should do less of.
Smoke cigarettes.
Something everyone should do more of.
Drink wine.
Yeah, and read.
I'm out here in the Bay Area, so.
There you go. Will people visit Mars in your lifetime?
Yes.
All right. Oh, Bitcoin, bang or bust?
Bust.
Bust. All right, Joe. I really appreciate all your time here spending with us and breaking down, exactly how to raise capital for commercial real estate, and also your insights on the market were really encouraging and really exciting to hear someone with your insight into the economy and your background. That perspective is definitely valuable.
Well, great, and I enjoyed it, Ross, and hopefully I helped out your huge audience out there.
Yeah. Well, for everyone that's listening, you made it to the end of the show. which means you start what you finish. A very small percentage of people actually finish any podcast or any YouTube show, but you stayed here to the end, so you found some value. So please go ahead and give us a thumbs up, like, share, at least put a comment. If you're watching this on YouTube and you don't leave a comment, that's not fair. We're putting a lot of time, energy, and effort into it. Just let us know what you like. So thank you so very much for being part of Connected Investors and listening to the Exactly How podcast. And I'll talk to you on the next show.
The Connected Investors app connects you with investors, notifies you of available properties, helps locate cash buyers, and secure private funding to close deals. Set up in seconds to become a member of the Connected Investors social network. Now you can scroll through your main feed to find cash buyers, see investment properties not available to the general public, and network with investors by adding your own comments to a thread to keep the conversation going. The Control Center is your connection to add properties to sell, start new discussions, connect with local investors, and even find private funding. The Notifications tab will keep you alerted to new investment properties and offers. You'll also find new friend requests to connect directly with the community to build your network. From the property marketplace, you'll be able to find, favorite, and make offers on investment properties. Download Connected Investors today to find, figure, fund, and flip investment properties on the go.